value investing. Value investing is not easy in the best of times. You can imagine what it's been like the last 2 years. Quite often we have to zig while everyone else is zagging. So what I'm going to do is I'm going to try and describe, explain, and highlight our value investment style. And hopefully I'll be able to give you a sense of certainly my passion for this business. As I was explaining to George over breakfast, there's no retirement age in my business. As long as you're mentally firm and you enjoy what you're doing, you can do this as long as you can. You know, look at Buffett, now 80 years old. What I've done, I'm dividing my presentation into four. I'll first give an introduction of what's gone on over the last 2 years, and then move into our ABC value style. George gave me a list of 9 points. I'll try and answer them all, so at least you have something, and then a Q&A. Now, feel free to ask questions while I'm going through this all. I'll also refer to our ABC Perspective, which is online. We do write this every quarter, and we have two websites, valueinvestigator.com and abcfunds.com. You're free to go on. As one of the fellows reminded me, I don't know if it was you, Daniel, whatever, but reminded me I was on BNN on Friday. So you can get a sense, if I can't remember everything I've said or whatever, or if I don't make any sense, you can certainly go on to bnn.ca and archive back to Friday, where hopefully I was a little more eloquent than I'll be today. It's been a long drive from Toronto. Okay, presentation. Introduction of the last 2 years. Put away your textbooks. With all due respect to you, George, and everyone else, including my professors, Harry Markowitz taught me at the Wharton School. Marshall Bloom taught me, who was part of that dart-throwing Marshall Bloom, Irwin Friend, and Gene Crockett, you know, throwing darts. You're probably no better than, or just as good as any manager. Let's put it all that way, Let's look back what has happened. The last 2 years have been incredible. Hard to believe, simply because there was a period from October of 2008 to March of 2009 when clearly nothing, and I mean nothing, was working. I don't care what you were taught in business school. Harry Markowitz never taught me about what was going to happen. Complete loss of confidence, incredible volatility, and people were, quite frankly, frightened to death. They thought this was the second coming of the 1929 recession. There was a period in January of 2009, and to this, it's indelibly etched in my psyche, along with every other manager in the country. During that period in mid-January of 2009, U.S. Treasury bonds traded at a negative yield, which, quite frankly, is absurd. In other words, you were willing to pay Uncle Sam to take your money, which is incredible. Now, why would that happen? George, I don't know if you can explain that. No one could. It was the absolute fear. No one was doing their homework during this period. There were stocks that were trading below cash value. Shouldn't happen. You could buy companies for less than cash on their balance sheet. Forget about all the widget factories and real estate and tax loss carry forwards they had on their balance sheet. It was just an incredible period. I'll go so far to say this. Our grandchildren will be reading about this period. When banks went bust, when Mr. Bernanke had to save the world, along with every other central banker. It was just an incredible period. As I said, nothing in our textbooks prepared us for this. And the psychology was remarkable because people were afraid to do anything. Anything. They didn't want to buy stocks. In fact, in many cases, stocks were better value than they were in a long time. As I said, you could buy cash at a discount. The market at that point was irrational, emotional, and nonsensical. Again, nothing like they've taught us in the textbooks, you know, efficient market frontiers and P ratios and price earning, cash flow multiples. No one for that 6-month period was doing their homework because they were, quite frankly, they were frightened to death. there were billions, trillions of dollars that evaporated. Some of the smartest managers were put under. My concern as a manager, managing 5 mutual funds, my greatest concern at that point was a run on my funds, that people would be reading the headlines of the newspaper and say, I don't care what it is, I want out and I never want to see a stock again. In fact, Warren Buffett, who I have the greatest respect for, made a statement in March of 2009, I believe. He said the US economy was going over the edge. Am I correct on that? Uncharacteristic of someone who is seasoned, but that was quite characteristic of the comments and the feelings that were going by at that time. We came so close to going over the edge, simply because the securities markets are based upon primarily one thing, and that's confidence. If people don't have confidence, they ain't going to open up their sporran to take out their money to buy stocks or bonds or anything. In fact, it looked like things were just going to go over the edge again in March of 2009, when the market in fact bottomed. There were a lot of analysts, front page of the newspaper, commentaries that just did not give you confidence to do your homework. Going back to myself and my team, we're 6 people, we manage about $1 billion. We were spending more time answering telephone calls from very nervous clients. Could we guarantee them that their money would be there for their retirement? Did we think the world was coming to an end? Did we see massive bankruptcies? In fact, in January of 2009, I had a client of mine who called and said, I'm leaving your funds because you bought some of the banks. I bought them as a trade back in December of 2008, early 2009, when all the banks were trading below book value. He said, don't you know they're all going bust, just like the American banks? So I don't want to overplay the point, but this was probably a once-in-a-generation experience. I'll never forget this. And a lot of my peers, whether they be in their 20s to their 80s, won't forget this. In fact, we're still not out of this. We've made a remarkable recovery, but even now the volatility in the marketplace is nothing short of incredible. Right now there's a tug of war going on between the bulls and the bears. One day you get phenomenal news. As I mentioned on Friday on television, Friday morning, Germany came out with plus 2.2% GDP growth, which was the greatest percentage growth since the two Germanys amalgamated in the 1990s. The market should have been ecstatic. Whether this number is sustainable for the next 12 months or whatever is something else. Initially, the German stock market was down 0.75%. It closed, I think, down about a third at the end of the day. But the fact was, good news is treated as bad news, and quite often bad news is treated as good news. The market is topsy-turvy, makes no sense. In fact, jokingly, I always start off any presentation I make, including that to 2 of my sons who are in the Rotman School of Business at U of T. I explained to them there are a lot of things that you cannot learn from a textbook. I said if I had to recommend a course to be the pièce de résistance of any course you're going to take in business school, it'd be a course in child psychology. Because people, I don't care where they are, where they're from, quite often are no better than children. They like to buy when everyone else is buying, and they like to sell when everyone else is selling. It's reinforcing. So if any of you have a psychology background, particularly in child psych, you're one up on the market. How you handle the pain that we've gone through the last 2 years is even better, if you have that ability. I used to come home at night after hard days in the office, and keep in mind, this crazy period from October of 2008 to March of 2009, start off with Lehman Brothers going bankrupt, and probably they should have been saved along with everything else because that was the tip of the iceberg. Up until mid-March, because I remember I was on spring break with my family, I was in Florida, And it wasn't a very good vacation. As I apologize to my wife and kids, my mind wasn't there, and it shouldn't have been there. The market was in the process of bottoming and taking off from there. Fortunes were made from the lows of that March to the subsequent peaks. But the bottom line is, we had a 6-month period where you're virtually in purgatory. As I said, nothing was working. Well, it continues today. Now, having said that, I've given you the grounding of what we went through. It was an incredible period. A lot of money could be made simply by sticking to your value investment philosophies. But interestingly, value investing didn't hold up at all during this period. We expected more from it, but we couldn't stop the psychology, the negativity in the marketplace. Front page of the newspapers. It was incredible what you saw. Had I not been in the business and understood what was going on, and even then there were times I just could not understand, for the layman on the street, reading front page, market collapsing, banks going bust, central banks just floating whatever, I never would have wanted to buy a stock in my life. But fortunately, we stuck to our style and hung in. There are a lot of funds that had to declare a force majeure. They stopped redemptions. And people who needed their money, whether they be in RIFs, retirement funds, couldn't get out. Fortunes were lost. For those who cashed out at the bottom, or close to the bottom, and they felt great, because the market was still going down, they felt pretty good. But a year later, the market had recovered a good deal of the gain, not quite all of it, but psychology was terrible. Anyway, I just want to give you a grounding. So given that, any questions? How did you people fare in this period? You were in business school, I assume?
I'm a student, that's why they came.
Thank you. Well, actually, a lot of you probably came because there weren't any jobs. And you decided, let me get an MBA and see what goes. Yeah.
I rode all the way down to the bottom, and I wanted to invest more. I didn't have any money, and the money that I did get, I did put it in at the bottom in March. So I felt pretty good about that, but maybe that was just luck. But I didn't sell it.
Well, you're probably better than a lot of portfolio managers. You probably would have multiplied what you invested by about a dozen figures. I can tell you that psychologically, it was debilitating for every manager. I don't care what they were. I spent the better part of 2/3 of my day responding to client inquiries, holding people's hands. That's what went on. Did we buy right at the bottom? Not exactly. We held on with a number of our positions. We bought a few things. The biggest problem for a money manager, it's one thing for you to manage your own money. I'm managing other people's money. And the lunacy, if I may, of what goes on is that we manage $1 billion. On 10 business days' notice, all my clients have the right to ask for all their money back. I, along with every other manager in this country, or the world for that matter, is vulnerable on 10 business days' notice to getting the carpet, the rug pulled, and you got to sell. You couldn't sell a darn thing in this decline. As I was asked on television on Friday, why didn't you sell Polaris Minerals? One of my stocks, one of my losers. I couldn't. There was no bid. Plenty of asked, no bid. So very difficult period. Having said that, psychology changes. And psychology is a little better, but still relative to where it was, say, 5 years ago. There's still a lot of negativity, and there are selective opportunities out there. The bottom line, what we're in right now is a combination trading market, it's a trader's market, and it is a stock picker's market. So if you're a value investor, you should be doing very well in this market because you're picking away at various stocks that might fall within your screen. We own no banks, no Bell Canada, no TransCanada Pipe, and certainly no Manulife. So a lot of our stocks are small to mid-cap, special situations. Many of them are dirt cheap. I will go through our ABC style, and I will give you a real-world example of what I went through in 2008 and how sticking to our guns is making us a lot of money right now. Okay, our ABC value style. Okay, what does it take to be a value manager? Look, there are many ways to skin a cat, and the bottom line is this. We all have our view of what value investing is. From our point of view, we call it our 10 commandments of deep value investing. It's on our website if you want to look. And they include 1, low price to earnings multiples. We don't like to buy stocks that trade at 50 times. We look for stocks that are cheap. The odd time when we'll buy a stock trading at a 50 times multiple is probably right at the bottom of its cycle, when it's just about to come out and start ramping up its earnings. Second thing is low cash flow multiples. You know, in real estate, they have location, location, location. In our business, it's cash flow, cash flow, cash flow. You can have the greatest company earning a ton of cash, but if it's all in accounts receivable, forget it. So we look at cash flow. In many cases, we're buying companies trading at 2 to 3 times cash flow, which to my mind is remarkable. And actually, in the 2008, early 2009 period, you were able, in retrospect, to buy certain companies trading at 1 times cash flow, which is absurd, but it was there. What we try and do is take advantage of the, how can I say, the frailties and in the marketplace, the absolute negative psychology in the marketplace to our advantage, being a stock picker. Discount to book or net asset value, point 3. We like to look at net asset values. Book value does not often describe the real situation. Book value on a balance sheet will give you the theoretical value of what a company is worth. But, as I told George, as you know, we look at tangible book value. We regard goodwill as 0. It's nothing. It's like air. And we look at tangible book value, which can be significantly different. We've looked at companies that look incredibly cheap. And when you take off the goodwill, in some instances, they have negative tangible book, negative value. In the case of Manulife, where I was asked on Friday on a telephone call on the BNN program, a fellow said to me, it's trading below book value. Probably is. But they have a lot of potential liabilities because they're vulnerable to the stock market via their variable annuities. It's like milking cows by candlelight. If I cannot analyze that, I cannot take other people's money to buy it. So as I said on television, I have no guts. Not there. I'll let someone else make the money. Fourth point, hidden assets. What do we look for? Well, natural hidden assets could be tax loss carry forwards. A company which has written off a lot of, say, bad divisions or whatever, might have tax loss carry forwards of several dollars a share. That's an asset on a balance sheet. Invariably, when we open up an annual report, we open it from right to left, not left to right. Because in the back, in tiny, tiny little print, where you literally need reading glasses, you will see these very interesting notes. Tax loss carry forwards. Litigation. Litigation can be a negative or a positive. Depends, can be favorable or negative. The other thing is inventory. Depending upon what you're using, whether it be LIFO or FIFO inventory accounting, we kind of forget about that. I forgot about that until one day about 11 or 12 years ago. I was analyzing a company out of Newport News, Virginia, which was in the HVAC distribution business. And a lot of their technology hadn't changed in 30, 40 years. But they were using LIFO accounting. So they were understating their inventory on their balance sheet by about $8 a share on a $25 stock. We bought it. We were wrong temporarily because the stock market didn't care about it. But when the company was subsequently bought out about 9 or 10 months later, we were well compensated because the stock was up 100%. Management. Well, look, everyone wants to invest in smart guys. Good management, which is key. You need people who've got guts, who are not going to fold in terms of tough marketplaces. You need people with intestinal fortitude. At the same time, as irrational as it may seem, We're looking for management that is incapable, sometimes even stupid, because they may be sitting on a great asset that an acquisitor can take and make 1 and 1 equal 3. So we look at management quite closely. Many years ago, Ian Delaney, who has made quite a name of himself on Bay Street, took over a company called Sherritt Gordon. It's now called Sherritt International. It was an acrimonious fight, but he won over Sherritt Gordon at the time, and he provided good management to get the value of the company up. Products and services for the present times and beyond as a 6th point. Look, you don't want to be buying a company that, say, makes buggy whips when the automobile has just been invented. Correspondingly, when high technology came in back in the early 2000s, when people weren't sure whether the light switch would work when we turned on, we want to make sure that we're not playing last cycle or the last couple of decades. So we're looking for companies with products and services that are going to be good for the next cycle. And actually, even stocks that have nothing to do with the cycle. We bought a company called Highliner Foods. It's a fish packaging company which packages shrimp, haddock, tuna. You know it as Highliner. The interesting thing is we rationalized when we bought it at maybe half of book value that, hey, we all want to live a long life. We're all eating fish today, trying to minimize our meat. We bought this. It was traded like a small cap. It's a good company. We bought it. And here it is trading roughly at book value. So we look for companies like that. At the time we bought it, there were only maybe 2 analysts in the whole of Bay Street who followed the company. As a 7th point, it's one thing to buy a cheap stock, but the thing you always look for a value catalyst. You can buy the cheapest house on the block, you can buy the cheapest stock in the stock market. You need a catalyst. You know, they often tell you, you want to buy that piece of real estate, that little barber shop in between the big office towers that hopefully someone will buy out. We're always looking for that. Because if you buy it, and invariably you have to buy it early. You look like a blooming idiot at times, but in the end it works out. And I'll discuss that later on when I give you a real world example. So you look for a value catalyst. Sometimes it doesn't happen, and ultimately you've bought a stock which is value, but it remains, you bought it cheap, becomes cheaper. And it just sits there and sits there and sits there. And in any event, that's the 7th point. 8th point, discounted valuations compared to its peers. If we're going to be buying a stock, we look at its peers. Invariably, we're looking at stocks trading at, say, 5 or 6 times PE, and their peers may be larger companies where you're actually paying for liquidity that may be trading at 10 or 12 times. We're looking at stocks that may be trading at half of book value as opposed to book and a half. One of our stocks that we like is Equitable Group, Equitable Trust. Its peer is Home Capital, a well-run company run at Hamilton, run by Gerald Soloway. That company trades at 2.5 times book, trades at a big multiple to earnings, and probably double the return on equity that Equitable Group has. Pays a 2% dividend. We bought Equitable Group. Boy, I'm having a tough time pronouncing it, but we bought it at 0.9 times book. Book value is $23.38. Stock is now around 21. They earned 3.25 last year, a little over. This year they should earn 3.15. Equitable Group is a mortgage lender. And a lot of people are fearful. They feel the Canadian real estate market will collapse like the US. Very different. Canadians tend to pay their mortgages, even if their house is a little underwater. But in any event, this stock is trading very, very cheaply compared to Home Capital. It's trading at under 7 times PE, free cash flowing. And what they're using all their free cash flow, they pay a 40-cent dividend, earning maybe 3.25, which is 0.12. It's 12% of their earnings that they're paying out. So conservative, and they're using all their free cash flow to buy more mortgages. The company has a market cap of a little over 300 million, a fifth the market cap of Home. It's very cheap, and excellent management run by Andrew Moore, and chairman of the board, and this is where you don't like to burn bridges. Chairman of the board is Austin Butel, ex of Butel Goodman, who happened to be my boss 25 years ago. You know, and I have a lot of respect for him. So here's an example of a peer trading probably 3-4 times to our cheapie that we bought. 9, contrary opinion and underfollowed by investment analysts. We like to go against the pack, and quite often value stocks lie in those areas that no one follows. The fewer analysts who follow a stock, the better it is. You know, I'm sure Buffett is the same way. You go against the pack. If there's virtual consensus on Bay Street, there was an analyst who was on BNN about 10 days ago, and he talked about Manulife. He said some of the smartest minds on Bay Street had recommended Manulife all the way up. And here it is hitting a 12-month low. He said, how can the average guy in the street beat the smartest analysts when they're all wrong on Bay Street, on the stock? So you've got to go against the pack, particularly when there's virtual unanimity. Whether it's up or down, it bothers me. When everyone has the same opinion, say on the buy side, who are you going to sell to if everyone's long up to their neck? So you have to think about that. And lastly, the most important thing in my business, aside from cash flow, is discipline, discipline, discipline. Stick to your guns. Stick to your business model. If you're a value manager and it happens not to be a value market, say a momentum market or growth market, don't change your spots. Stick to what your spots are. It's tough. You get yelled at. I've heard every 4-letter word from clients calling me an idiot and whatever. That's not a 4-letter word, but there are a lot of others. How could you be so stupid and whatever? The fact is, when you buy a stock, you don't know what's going to happen 6 or 12 months. There are a lot of factors that are extraneous to your investment decision. Acts of God, things that just happen, you can't stop. So we have to be aware. So 10 Commandments, we put it all together. It's not a black box, it's fairly simple. And then we analyze stocks. Myself, my associate Jeff Sayer, all day long we're doing analysis, looking for something new and different. Any questions? Yeah.
In your analysis, you talked about having some hidden assets such as some tax credits or some of the other things which you can really quantify. How do you go about quantifying some of the other intangibles such as customer service, product portfolio, or how quickly the company comes up with new products, or you just let it as an upside?
Sometimes you make seat of the pants decisions. You make multi-million-dollar decisions on gut feel. I'll tell you a few things to relate it to today. I don't know, 15 or 20 years ago, we just bought a new house, my wife and I, and we ordered, had a fellow come by to put a fence, cedar fence around our house so my kids wouldn't be wandering off. Fellow comes, he had like a toothpick in the corner of his mouth, one of those. And smart guy, he looked, and he says, that'll cost you $3,000. I said, wait a minute. How can you tell me $3,000? You haven't even measured it out. And he said to me, Sonny, you think this is the first fence I put up? So the fact is, there are a lot of things you go by gut instinct, gut feel. And I try not to overanalyze things. I can feel it. It's like having 2 antennae in the back of my head. You can feel it. It's something that is intangible. George, I'm sure when you analyze, there's certain things you feel because you're experienced. I remember you sent me an email, I think it was January of 09, saying we're going into recession. Even if I agreed with you, there are certain stocks I just could not get out of. So, the old saying, best laid plans of mice and men half go awry. Sometimes you have your plans, you can't do it. So in a way, to answer your question, there's no hard and fast rule. A lot of things, how can I say, even with my wife, she'll call me up after I've made 10 or 20 multi-million-dollar decisions before 4 o'clock. My wife will say to me, what do you want for dinner? I say, look, I don't know. She says, come on, what do you want for dinner? I said, look, I don't know, whatever you want. She says, can't you make an investment decision? Yeah.
Just so I understand it correctly, so you basically, when you're putting an entry price to a stock, you don't really put a number to some of the other intangibles that the company may have.
We do. We have to, as I said, seat of the pants. We'll look at a company. We know what the book value is. We know what the cash flow is. We find some hidden assets. Right through our 10 Commandments. We will put our own valuation, and we'll discount it down a little bit here. The thing that we cannot quantify is all the other lunatics out there who may be selling. Invariably, we buy in early, and we cannot quantify the psychology in the marketplace. As I said, it relates to a lot of child psych. Everyone likes to go together. It's reinforcing. So although we thought we've figured it out, there are things, forces beyond our control that you can just not quantify. I don't know if I've answered. Yes, sir.
Based on the insanity that we saw back in 08 and 09, and in your experience, you think if this thing was to repeat itself in 10 years, would the market reaction be any different? And if that is the case, should value investors do some mending to their rules so that they can adapt accordingly?
Interesting question. I'd like to think what we saw over that 2-year period, or particularly that 6-month period, was a once-in-a-lifetime occurrence. Keep in mind the crash of 1929, we didn't see for another 70 years. The bottom line is, as Santayana once said, we're doomed to repeat, history, doomed to repeat if we haven't learned from our history. A lot of mistakes will be made again. We'll try and, people today are combination shell-shocked and sensitized by the marketplace. There are a lot of things I wish I could have done, knowing what I knew 6 months after. Who knew that a number of banks were going to go bust? Who knew that the Federal Reserve would not bail out Lehman Brothers, which was the straw that broke the camel's back? Who knew that Merrill Lynch would go bust and Bank of America would take it over? So, we're all doomed to repeat the same mistakes. Tough question. Things go on, and there will be a lot of different parameters or different factors that will affect the marketplace in 10 years' time. The fact is, you have to be paying attention. You have to be sticking to your guns. And there is as we had here, because the market probably was overly exuberant in the 2 or 3 years before we had the 08 catastrophe in the fall. We have to be sensitized. And quite often, a stock or a group of stocks or the stock market will be overvalued, but just because it's overvalued by 10 or 20% doesn't mean it can't be overvalued by 100%. You cannot quantify how much straw it takes to break the camel's back. So a stock market can be overvalued for years, and it can be undervalued for years, right? Long history. We don't know. A lot of it is psychology. Thank goodness we had the coordinated action of all international banks pumping in money supply, and quite frankly, where I come from today, we have to keep on pumping. The Federal Reserve will continue, and the Bank of Canada should continue to supply money to the system. I like what they did in Germany. The German central bank, and all through fiscal policy, provided employment subsidies whereby 50 to 75% of salaries were paid by the government. We need corporations to hire back employees. And right now, you as a corporation, you don't want to hire people back. In fact, here, let me give you a real world example. You're president of a company. You got killed in 2008. You let go of a third of your workforce. And right now, business is picking up. But instead of hiring back those people that you let go before, you're having your employees work double overtime. In fact, it continues to work well. It's increasing your productivity. Productivity up to this point has been phenomenal. Now you have them working triple overtime. I think you're right at that tipping point right now where productivity has been maxed out. Businesses today are frightened because they have to make that big decision. At what point do I hire back previously employed clients or employees, where I have to pay them all sorts of benefits, and you're on the hook because once you hire them back, you can't fire them next week. Something like this is a dilemma that, well, this is a dilemma we're in right now with, we need to get confidence back in the system. There isn't, consumer-wise. Consumer spending is 70% of the US market. Until we get Americans working again, you know, US unemployment around 10%. Well, look, 90% are still working. And I defy you not to buy things on sale today, whether it be in Canada or in the United States. But the fact is, it's confidence. Confidence, psychology is driving the marketplace right now. And that may be something affecting the market again in 10 years for completely different reasons. Anyway, hopefully I've answered that question.
My question was about holding money as a percentage of your funds. Do you find yourself holding money, and maybe if you do, what's the highest percentage it's been if you can't find anything of value?
We can hold as much cash as we want. The highest I've ever been is 40%. That was back in 1990. I can't say we had a lot going into this cycle because we had a lot of stocks that we thought were deep value, were good. Over a short period of time, we looked stupid. Today, we're fully invested. T-bills today are yielding about 1/4 to 0.5%. I use that as my RF, my risk-free capital. What we're finding today, because the stock market it's not as cheap as it was a year ago or 2 years ago, but we're still finding stocks that are yielding, say, 2, 3, 4% with potential for capital gain of 20, 30, 40, 50%. So the fact is, for my risk-free rate of return, if I can earn 4%, which is 8 times what I could earn sitting in a riskless T-bill at 0.5%, with potential for capital gain, I'll do that. And we're finding that. That's why I hold Genworth, because we bought it below book and yields me 4%. So I'm willing, a lot of other people say, the guy's nuts. Doesn't he know Genworth, which is part of a duopoly, that along with CMHC, are the 2 biggest mortgage insurance suppliers in this country. They have 98% of the market. I think they're in good shape. I like them, and Genworth was debt-free. They're now doing a share buyback. So I'm willing to take that risk-reward. There are other instances where, you know what, I'd like to have a little bit of cash. And as I said before, the sword of Damocles overhanging me right now is the fact that I'm managing open-ended trusts. And I don't know if the stock market falls today 10%, I may have a lot of my clients wanting their money back in 10 business days, which is their right. Yeah.
Sorry, ask a follow-up question related to that. Yeah, I wanted to know what your thoughts are about people like us, our chances of managing our own money and doing maybe as good as, for example, our alternative is to give money to you or a company like yours. What do you think of that? Because I guess that's a personal decision I'm thinking for the future, and I'm sure other people are like, well, I could do it, or I could give it to someone who does it full time.
Interesting question. Look, invariably, your own personal portfolio compared to the one you're managing will differ. You have different risk rewards. For your own portfolio, you may decide to be a big punter. You'll take a risk on something. I'm in a fiduciary capacity. I'm tracked by the Ontario Securities Commission. On 24 hours notice, they can audit my books. I can have class action suits. I can have anything and everything. So you take different risk reward. So I do not, and by the way, I do whatever my clients are doing. So I'll tend to buy the same stocks as my funds after the fact. So my cost may be higher or lower depending upon what happens after I've completely bought for my funds. Tough to say. As I said, we're under completely different constraints as a money manager. And look, it's one thing for me to buy a stock and it's down 50% from my own account. You chalk it up to experience. If I'm down 50% in my fund, and I've been there before, at the lows of the marketplace, I know it's going to happen next morning when I'm in my office at 9 o'clock in the morning. I'm probably going to have 80% of my clients calling me, you know, didn't you see that headline in the Globe and Mail that the market's going to is going in the ditch, and you know, all these funds are going bankrupt, and the banks are going bankrupt, and Manulife's going bankrupt. You know, it's like broken telephone. Completely different set. So I will take different risks, and so will you if you're managing money. I can give a whole treatise on this, but I won't. Completely different ball game. You're under completely different rewards and risks. Okay, let me get into a stock that I picked. And I want you to relate it to my 10 commandments that I've talked about. We went through Hell's Half Acre when we bought it, and now we look like we're bright. We're Einsteins. That wasn't the case. The stock I'm going to talk about is Fortress Paper Limited. Anyone know it? You're about the only one. Probably the only one who reads newspapers, and probably the only one who'll know what I went through. In June, July of 2008, before the crash, RBC Dominion Securities was underwriting an issue called Fortress Paper Limited. It was a Canadian company, in name only, because it was run by Chad Waselnikov, a mid-30s entrepreneur who had made a little bit of money for himself before. He bought out from Mercer International 2 divisions. A company a division out of Lankart, Switzerland, that was a printer of currencies. They're one of the, I think, 10 official printers of the Eurodollar. They produced Swiss franc, and they would produce passports. They were in the printing business. So that was the first part of the company. And when we went through the prospectus, a beautiful photograph of their plant in the midst of the Swiss Alps, and I thought for a minute I was looking at a travel brochure. But they were in the printing business. The second part of the company was a non-woven wallpaper. Now, non-woven wallpaper, as opposed to your normal wallpaper, this is strippable. It's a very different sort of wallpaper. So if you strip it off a wall, it won't take all of the drywall with it. Apparently, this company, which was based in Dresden, Germany, just south of Dresden, on the banks of the Elbe. And all I remembered about the Elbe, that's where the Americans and the Russians met at the end of the Second World War, where they shook their hands. So I remembered it. Wow, this is interesting. On this plant, because when I told my wife, she says, wallpaper? Aren't you? You're an idiot, she said. And this is convention, by the way. Who buys wallpaper today? Everyone does faux finishing. You know, you use paint and you fix up your wall. And I said, not in Eastern Europe. In Eastern Europe, they tend to buy this non-woven wallpaper to hold all those Soviet-era walls at apartments that are crumbling. So this was a plant, state-of-the-art in Dresden, Germany, on 26 hectares of land, right on the banks of the Elbe. Not exactly the most picturesque part of the Elbe, but it was there. They had their own self-contained power plant, and they owned 26 hectares. Well, we looked at this. The company needed the financing to go public, and they want to go public, I believe, at the time, 10 or 12. We looked at it, and we told Dominion Securities, pass. They were having a very difficult time. All they wanted to raise was about, I don't know, about $25 million, just to take the company public so they could pay back Mercer International. We got a call again from the company, from Dominion Securities, and they said, please look at this company again. To our credit, we went through the prospectus and discovered that the assets the company had bought were insured for 3 times their value. Now, why would a company insure assets for 3 times their value? Obviously, because they're worth more. Because these assets were bought at a very low price, by law, the company couldn't write them up on their balance sheet. But what they did do, they insured them for replacement costs. Now, whether you truly wanted to replace them at those costs is something else. So we looked at this and said, look, they've said they will go public at $8. We think the company has a net asset value of 15. We went ahead and we bought a lot of stock at $8. We put it in our 2 closed-end funds because we knew we'd be right eventually, at least we thought we would, but we knew there would be very little liquidity in the stock. Stock went up a little bit, went up to about $8 or $9, $10. We decided not to sell because we thought we had a target of 15 based on NAV. We really liked management. We hung in. Suddenly we get September, October of 2008. Lehman Brothers goes bust. Stock goes to 4 3/4. We're off 30, 40%. We bought a little more stock because we believed in this. Clients were yelling at us, how could you be so stupid? Why did you buy it at 8 and here it is at 4 3/4? They said, look, we believe it. The assets are there. We bought more stock to bring our average cost down to 7 3/4. We went over 10%, so we had to file. We own 11% of the company, had to file with the Ontario Securities Commission because we went over the threshold. At my cost, by the way, because I have to cover all this cost of filing with lawyers, etc. We suffered through this for a good 6, 8, 10 months. Suddenly, mid-2009, mid-late, stock started to move up because they were coming forth with their earnings and people were starting to discover the stock. It went back to $8, and normally what people do after it goes back to their cost say, phew, I'm getting out. I get all my money back. Clients, I can tell my clients, jump off a cliff. I got all their money back. We analyzed it. No, we still believed in $15. So we hung in. Went to $9. We actually had a little bit of money in this. Went to 10. And by now they had good earnings. Suddenly people were waking up to the fact that the printing business was good, and their non-woven wallpaper had a maximum 8 to 9 weeks of sales. And their inventory was pretty clean. Suddenly an opportunity befell the company. It was a two-legged stool. And to his credit, the president of the company, CEO, 38-year-old Chad Wasilnikoff out of Vancouver, had a bright idea. There was a pulp mill in Quebec called Thurso. It was part of the old Fraser paper. It was shut down, and he looked at this, and pulp is now running up from, $600 a ton. It was running at 900. This is what we call NBHK pulp, regular pulp that you use to make paper, whatever. Chad, through various people, had discovered if you convert the plant, get some equipment, you can convert it to what they call dissolving pulp. Dissolving pulp you can utilize to make rayon, clothes. Rayon is a competitor to cotton. Cotton prices have gone up. He lined up the mill, lined up financing, and to make a very long story short, the Quebec government wanted to see all the people that were laid off, 350 people plus laid off at the plant, and the Quebec government lent them over $100 million at like 5%. And a Quebec investment company lent them, I think, 15 odd million, and a convertible debenture convertible at $20. Now, who buys a stock at 20 when the stock's at 12? Suddenly the street woke up to this. And to make a very long story short, the stock is now closed on Friday at $28.60. It's more than a triple. I was a bum. Jeff and I were bums for a period of about 12 to 15 months. Now we're heroes. What can I tell you? Sticking to your guns. If I'd sold a stock at 10 or 12, no one would have argued with me. Took a profit. It was too risky. Got your money back. We hung in. Now the big question for us right now, when to leave the scene, because it's no longer a deep value play. It zipped right through our $15.
If you buy the stock because you get the price 15, why would you get out at 15 if you just wait? Did you buy the stock? You buy the
It didn't stop at 15, because once they took on this mill, this has the potential of cash flowing, like $50 million. Suddenly it's a completely different ballgame. This company went from being a deep value stock to a growth momentum stock. You're going to change the multiple. You have a whole new class of investors saying, hey, wait a minute, look at this. What they also did, they just raised $47 million. They did a stock offering at 23.5. If you want to see the whole story behind this, go into my website, valleyinvestigator.com. You'll go under Fortress Paper. I've got as one of my friends says, I've got a Hollywood problem right now. A Hollywood problem. What's the problem? I put the stock in my 2 closed-end funds, 1 out of 40 stocks. The stock has more than tripled. I put it in as a 3% position. One stock at a 40 is now 20% of the portfolio. Now, I know the stock's going up. George, do they talk about this in textbooks? Now I have to put aside all of my investment analysis. Throw away P multiples, premium to book, and all this stuff here. What do? Fiduciary tells me I got to lighten up, whether I like it or not. One, if the stock goes back to 10 for whatever purpose or reason, I'm cooked. If it goes up, even if it could very well go to 50, because Bay Street now loves the stock. They didn't like it when it was at 4 3/4, 5, but now I've seen analyses anywhere from $35 to $40. One analyst said to me unofficially, I think it's a $50 stock. You've got to use the psychology on the positive as well. I won't tell you what I'm doing or what I intend to do, but I'm in this business because I want to stay in this business. But you know what has to be done. That is Fortress Paper. Now, in the past, whenever we bought a stock and you sell it, I'm going to talk about psychology here. I remember historically, I was in a company, I became we owned a lot of stock. We liked the company, and you have to differentiate between liking the company, liking the executive, and liking the stock price. Completely 2 different things. So you like the company and you like the president, the stock is dirt cheap. You go golfing with the president. You might invite him over to your house swimming, in your pool, with the kids and everything. You go out for dinner with his wife and your wife. Suddenly the stock doubles. It's not dirt cheap anymore. You decide, for fiduciary and for common sense purposes, you've got to lighten up. Now you say to yourself, oh my goodness, how am I going to break it to when I start selling? I'm like Benedict Arnold. I've turned on my people. You might feel pangs of guilt. These are things they don't teach you in a textbook. How do you sell? How do you break that psychology? I leave that to you. Because invariably, when we like a company, we buy it. We did the same thing. We owned Danier Leather. We bought 9.9%. My wife loves Danier Leather. She likes to buy coats and everything there. It's cheap, good value for your dollar, whatever. The stock went from, we bought it at 10 below book. It went all the way down to, I think, $3, $4, where a big fund had to ditch their stock. We've become good friends with Jeff Wartzman. His daughter happened to be at the same class as my daughter, but I liked him anyways because he was a good manager. He owns multiple voting stock. He went through some tough times. He even had a lawsuit against him when he went public. And that's another, he won that and picked up money for the company. But more importantly, the stock went down to about $3, $4. Couldn't understand it. I had clients yelling and screaming at me. You paid 10 and here it is at $3, $4. Even if I wanted to, I couldn't get up. To make a very long story short, they've turned the corner, and most recently, they bought back 1.2 million shares at $6.25. They did an auction, a tender. 1.8 million were actually tendered, and he only bought back 1.2 million because that's all the board allowed him to do. He bought back stock at 6.25 when book value is at 12. It's accretive. The company has no debt, but $25 million in cash in their balance sheet. All that cash is used for inventory because it's the inventory cycle. They have to build up at this time of the year because they sell at Christmas time when everyone wants to buy leather. But they're also a function of the weather. If it's 30 degrees or Celsius outside, no one's going to buy a leather jacket, a leather skirt, or whatever. The mercy of the marketplace. Quite frankly, as I told them, you continue to do your good thing, operate well, buy back your stock. When you decide to go private, you come to me and pay me a fat price and I'll sell you all my clients' stock. I'm facetious, mind you, but that's a story. Here's another one. Officially, I think there will only be 1 or 2 analysts who follow the stock. But that's another good example. Anyway,
So did you ever go to the store and visit the store and see what they do? And
yeah, all the time. I go with my wife. I bought a few jackets there myself. And great business model. Fortunately, he never went into the States. I think he's got 91 stores. He's done extremely well, sticks to his knitting. He benefits from a strong Canadian dollar because he'll buy his lambskins all around the world. He'll buy it from Syria. He'll buy from Indonesia. He'll go all around the world.
you met him in Turkey. That was a turnoff.
Yeah. Well, hey. I know. Cyprus War, you're in the army, huh? No big deal. Look, when it comes to business, a lot of people don't look at the politics and everything. You can't. Look, you want to back the horse, you want to back the jockey. The bottom line, he does a great job, as does Chad Wasilnikov of Fortress Paper. So, that's that. Any questions before I try and attack your 9 questions? Okay, good. Okay, you said, one, what principles do they apply? Okay, you said here what, first part of the course will cover investors' basic approach to value investing. Practitioners will be asked to address the following questions. Okay, one, what principles do they apply in searching out investment opportunities for detailed study? Well, my 10 commandments. The most important word in my vocabulary, and it's not only investment, it's in my personal life with my family, and I try and teach my kids the same thing. The one word, so you don't go over the edge, that one word is control. I like to be control in my life. I like to have control. You try and frame your responsibilities. I was asked on television Friday, what was it? It's a trader's market. Are you going to trade the market? I'm not that good. There are 100 guys that trade the market better than I. They will play on little squiggles on the chart and they will trade like that. I can't do that. We're deep value investors, so if we find a Danier Leather, if we find a Genworth, an Equitable Group, or a Fortress Paper, that's our baby. We want to know it cold. I don't mind filing over 10%, but we want to hang in. So control is important. Discipline is important, as I said at number 10th point. Focus. You have to be rational in an irrational environment, a nonsensical market. Not easy. So, believe me, we did a little bit of everything, including our 10 commandments. 2, what kinds of information and securities are they seeking? Look, we look at all relevant information to ultimately make a decision. Ordinarily, we don't buy any high technology stocks because they trade at huge multiples to book and break up and everything. Most recently, in the last 12 months, we bought 3 tech companies that are cheap, trading below book. I'm not going to tell you what they are because I'm still buying them, but I think eventually they'll move from value to growth. Interesting thing, there's a cycle. When stocks get creamed, so to speak, really knocked down, value people buy them. When they start to pick up and momentum and earnings start to improve, you get the growthy guys who look, and that's when the momentum guys come in as well, and the value people tend to sell out because, it's trading at twice book, you bought it one time, and you laugh. You say, what do these guys see? I've sold stocks like that, made 100%, and saw them go up another 300 after I sold them to a growth guy. When the growth and momentum guys get onto the stock, it can be to the moon, Alice, and that's what goes on.
Like what kind of database are you using when you're looking for these stocks? How do you find them? Like, are there specific databases that you like?
We have a database out of Boston. We pay. It's a soft. They look at a lot of different parameters, so we look at that base. I listen to the street. Even a broken clock is right twice a day. So a lot of analysts, some guys, are completely wrong on things and will do the opposite, but there is some good work done out there. And sorry, I'm a little facetious. The street generally does a good job, but quite often they have an axe to grind. So we'll look at that. We look at newspapers. We look at when I wake up in the morning, I look at the new low list on the TSX. Now, quite often there's a reason why a stock is hitting a new 12-month low, but sometimes a pension fund or a mutual fund has to sell because they run on their funds. We'll analyze it. We look at everything. Yeah.
as a value investor, do you also rely on technical investing at all when making decisions?
Whenever we find a deep value stock, before we buy it, we also look at the technicals. So I can tell you, Fortress Paper, the moment it went through 15, we saw it at least to 20. And once it hit the 20s, it's a $30 stock. So we look at these things. You know, you look at points because the market is very psychological. And, you know, by the time it hits front page of the paper, whether it be good or bad news, quite often the opposite happens. So anyway, yes, we look at technicals. Yeah.
As a layman, when you're evaluating a company's stock and you see litigation on the balance sheet, now, like when we look at the litigation, it could be like a number which is running in millions of dollars. But how do you as an investor see to it, and what do you attach a probability of, you know, that there would be a reappeal or something else would happen? How do you look at litigation case?
You don't. You can't bet on litigation. That's one thing I will never bet for or against. But I want to be aware that there's litigation out there. Because, you know, I don't want to bet on a judge, what a judge is going to decide on a, you know, a one-off case. I don't know what's in his mind. I don't know what he ate for breakfast or what he's, you know, how he feels, or maybe he doesn't like. Look at the Conrad Black case. You just don't want to bet against it. So we'll look at it. I want to know if there's a lawsuit for or against the company. It all goes into that, you know, you're making a stew. You put everything in the stew and then you taste it. If it tastes okay, you buy it. If not, forget it. Look, we'll analyze 10 stocks. We may only buy 2 or 3. Yeah.
As a portfolio manager, do you attach any value to diversification at all as a value fund? Like, do you guys tend not to invest in one industry too deeply, or is there any? I know value funds don't generally regard diversification as a big factor, but is there any judgment there at all?
Okay, interesting question. Theoretically, they teach you in business school, you should be diversified. However, we're stock pickers. Generally, all the banks are cheap, or they're all expensive. All steel companies, whatever. We're stock pickers. So quite often, I know we've made money on insurance companies a number of years ago because they're all cheap, and I couldn't make up my mind, so I bought them all. So as a stock picker, our ABC funds have a very low coefficient of correlation to the TSX. In fact, in many cases, beta is completely irrelevant. Danier Leather has nothing to do with the TSX. Neither does Fortress Paper. Fortress Paper found a catalyst. One of my 10 commandments, they bought this Thurso mill, and to their credit, because it was out there for everyone to look at, they were able to transform, or they're in the process of transforming an NBHK pulp mill to dissolving pulp. And what have they done? They bought all the equipment out of Stora Enso out of Finland at pennies on the dollar, because Stora had all these, the extra equipment for dissolving pulp. It's been shipped by sea, and it'll be barged up, I guess, the Ottawa River or something. So there you go. Yeah.
I noticed that you use, or at least companies, you do some screening of your stocks in a database of some sorts. Do you use software for the second level of screening, maybe, you know, rules-based engines to do like evaluations, things like that?
No. Quite often, you can feel it. Just like that carpenter was going to build my fence. You knew it right away. We knew Fortress would. We even knew Daniel, oh boy, was testing our patience. You need the patience of Job. So you can also overanalyze, because quite often an anomaly may last 5 minutes, 5 hours, 5 months, it can be 5 years. But if we see something and we say, gotta have it, because intuitively we know it's cheap, I don't want to tip off too many people. Sometimes you overanalyze. You tip off a broker, you've got to watch who you deal with, because they all have a wine glass to the wall. So when we're buying something, mum is the word. We don't want to advertise our footprint, buying or selling, because a lot of people would love to know. What kind of investor rationalities do they consider? I put everything. You know those two famous words in the investment world, fear and greed. Greed at the top, fear right at the bottom. How many were fearful in that 6-month period up to March of 09 in this room? I mean, no one wants to admit it. I mean, you're probably the only honest person here. Even I was fearful. I don't know what you were seeing, George, but it was really rough. You had some pretty smart people, Nouriel Roubini, for one, and a lot of other economists who saw this thing over the edge. The one thing that a lot of the Cassandras missed is that they're right until you hit that inflection point and some catalyst out of nowhere. You know, in March, that was the worst spring break I ever had with my family. The worst. Because I was close to my cell and everything, and that happened to be the bottom of the market. In fact, the one statement I love to repeat, Elaine Garzarelli, do you remember her? Mm-hmm. She was the one who forecast the 1987 crash. She was terrific, except that was the peak of her career, I think. But what she said, and one of her quotes, and I use it over and over again, she said, I can't get the exact words, but the moment I feel my stomach churning and I start to doubt my capacity as an investment analyst, money manager, I know the market has bottomed, or I know the stock has bottomed. The fact is, psychologically, and I've said this a number of times, we're not immune to human frailties and psychology. It's part of it. Man, you can't be a robot. Hey, we all read newspapers, we all watch television. You know, the black humor that was coming out, you know, from radio announcers, TV announcers. The world is going to an end, and you know, pack up, and you know, you better buy, you know, your Campbell soup and everything. Prepare for this Armageddon, whatever. We made it, just like we made it through the 1929 crash by the mid-30s. Look, it may take a lot longer to get out of this, but the fact is, money can still be made. This is a value market for those who are willing to look.
As long as you are not overly leveraged.
No, we don't use leverage. I don't use leverage personally. And my funds, people ask me, do you have a hedge fund? No. My funds are long only. A lot of hedge funds had to close up. Some pretty bright people. Remember, leverage or leverage, depending on where you put the accent, is a double-edged sword. It can work for you and against you. And in a very precarious market, it doesn't work. What periods lead them to greater or lesser investments? Well, keep in mind their seasonality. Summertime, holidays, Christmas. Like right now, the markets are extremely thin. Most people are away on holiday. So my wife and I went with my daughter to Paris in early mid-July to visit our family. And the fact was, I did no trading during that period. Now, people go on holidays, and keep in mind, portfolio managers are mums and dads. So in the summertime, there's less activity, market is very thin. And by the way, there's another factor which we see in the market right now, and that is the brokers. They're not putting up a lot of their risk capital on the line. 3, 4, 5 years ago, I'd call up a broker. I'd say, look, I've got 100,000 shares for sale. He would bid principally. He's not putting his risk capital on the line anymore. It's now all agency. I don't know if you're seeing that, George, from your theoretical studies. People are still frightened. They're not putting up the risk capital. So a lot of seasonality. Christmas, a lot of the insurance companies shut down in early December. They've taken all the gains and losses they want. Invariably, the time you want to be in the market is like December 15th or 16th or 20th. If someone has to sell stock for whatever reason, there ain't no bid. You put in a bid. And the other thing is that committees have to meet. So after the summer, investment committees at big institutions will meet after Labor Day and decide what they're going to do for the next 3 months to the end of the year. How do they define and estimate value? Well, I gave you our 10 commandments. We look at net asset value, we look at psychology, we look at fear and greed. There are a whole bunch of other things. And if you go to other managers, they'll give you their reasons. We look at everything. As I said, you're making a stew. 6, how do they factor in asset values, related securities transactions, industry economics, firm strategy, management behavior? There's a lot to talk about. Well, look, we utilize everything. P's, NAV, market psychology. The problem is I get 300-400 emails a day. After a while, it's information overload. But I don't automatically click off, delete every email I get, because that one little bite of information could be the difference between making 0 and maybe 100%, or maybe saving money.
So you seem to me that you're more opportunistic as opposed to like the Buffett style, which is buy and hold for the long run, right?
We are opportunistic. Look, we're doing, if I may be so brash and bold, we're probably doing what Warren did in the 1960s when he was small. Today he is the market. And everyone wants to know what he's doing. He may be the sage of Omaha, but the things he does, when he cuts a deal on a private basis, he's doing a convertible preferred. I can't do that, but I can get in and out of a stock that he can't even dream of. He'd never buy a Danier leather. He'd never buy a Fortress paper. It's too small. So very different, but he was probably doing this sort of thing back in the 50s and 60s. How do they, if at all, account for differences between market prices and intrinsic values? What collateral information do they examine? Look, the bottom line is value. Value may be 50 or cents or a buck either way, but keep in mind the market is irrational. The market is imperfect. Now, it's not what they taught me at the Wharton Business School, and probably what we're all learning in our CFA courses and MBA. The market is imperfect and irrational. I repeat again. And looking back in that period from October 08 to March of 09, boy, was it ever irrational. Buying companies that for under cash value, below net asset value, the world was coming to an end. You better get out quickly.
Do you have any explicit margin of safety? You say, this is what I think the value is, but I'm not going to buy until it goes like.
You know what? Sometimes if you wait for the last the last little penny, you miss it. Quite often you have to buy early because you have to buy, for me to buy Fortress paper, I knew I was buying early. Actually, I didn't expect it to go to 4 3/4, but I did think that I was buying value. I was able to get my size by buying it early. There's an old saying that I love to repeat over and over. Better to be a year early than a day late. Tell that to all the people with Nortel who never sold it at 121 3/4. If you were late, you couldn't get out. Fortunes were lost. And what's Nortel today? It's nothing. When I go back to that period of 2000, because I lost a lot of clients because we refused to buy Nortel. It was trading at, maybe it was going to earn a buck, trading at 121. I don't buy stocks at 121 times. It was 10 times book value, and a good deal at book value was goodwill because they were using their stock to buy other companies. I lost a lot of clients. Buffett probably lost a lot of clients as well because he refused to buy the high techs. We hung in. And I remember going to our pharmacy to pick up some prescription. My pharmacist, who I happen to like a lot, said to me, "What do you think?" I said, "About what?" He says, "The market." I said, "Well, what do you mean?" He says, "Well, I just bought Nortel at $60. It's a great bargain. I bought it for half of what it was trading at before." I said, "Well, why'd you buy it?" And he gave the classic answer. He said, "They always come back, don't they?" Not always. Let the buyer beware.
Can you just talk a little bit about the value traps? How do you identify them? How do you
You don't.
notice them?
I mean, I bought value traps before, and that was the word I was searching for when I was talking about value. Quite often, you buy a cheap stock, and it just doesn't pan out. You buy it cheaply, and you sell it cheaper. So the fact is, there's that thin line. For a while, people said to me, Fortress paper was a value trap. Fortunately, you had that catalyst. In the case of Danier, I've heard value trap many times. The fact they were able to buy back probably 25% of the company, half of book value, that was accretive. That was the best use of their capital. I have a few other stocks where it is a value trap. They are. And at some point I'll get out. But I can't get out now because there's no bid. Yes, sir.
So, as a value investor, do you go looking for value players in emerging markets, or do you still think they're too risky and data is not legit?
I don't know. I tried. We went into Australia, we went into Singapore, we went into Hong Kong. By the time I wake up in the morning, Hong Kong is shut down. So what we'll do, we'll play those markets by buying Canadian companies that are, their main business is overseas. We can buy a company out of China, but it trades on the TSX. It's basically, it's gone public here. At one point we bought Magao, which is a fertilizer company out of China. We bought it, made our money, we're now gone. We made, I don't know, 50, 60% on our money, rather than buying a Chinese company where perhaps the president doesn't come to Canada for various meetings and can't speak a word of English. So it's very difficult to analyze. Also, whether you be in Europe or Australia or whatever, their accounting rules are different than ours. School of Hard Knocks, been there, done that. I'll buy Canadian companies. Plus, we happen to be bullish on the Canadian dollar. When the Canadian dollar, we missed it going up to par to 110, but then it went all the way back down to 80 cents, the Canadian dollar, about a year or so ago. So what we did, we converted in two tranches, a bunch of US dollars at $1.28, and then the balance of it at $1.25. And here's the Canadian dollar today, what, 105? Has been higher. We tend to be bullish on Canada, although we expect it to be very volatile. I'm not a Forex trader, but we look at the fundamentals. As long as we get the big trend, I don't expect to get it right at the bottom, nor at the top. Got to leave a little on the table, because it's a zero-sum game. You sell to someone, or you buy from someone, they've got to be completely opposite to you. What did we have here? 8, how do they define and manage risk? Depends what you value risk at. It's volatility, odds, chance, expected earnings, whether they're going to happen or not. Very difficult to control. Some people say they can control risk by, shorting options, futures, or whatever. We don't do that. We don't use synthetics. We're long only. Yeah.
So earlier when you were talking about Porsche, you said it was valued at, you valued it at 15 and you went in at 4 or 8 and then 4. It went to 15, then you valued it again as a growth stock. And now it's at 20, is that right? Or something like that?
Yeah.
Is your valuation, and I know you can't say when you're going to sell exactly, so maybe just in the past, you typically sell it when it hits what you valued it at?
Ordinarily, yes, but we don't do it just right away. We go back to the drawing board and say, look, our target was 15. What has changed? In the case of Fortress Paper, a tremendous catalyst. They probably doubled the valuation of the company by buying, by taking over the Thurso mill. Now, I'm told that replacement cost of that Thurso mill is between $600 to $800 million. And all they bought it for $3 million. $3 million bucks. So I have to throw out our $15 target and say, look, this isn't going to happen overnight, but it's certainly worth more than 15 bucks now, because we were just valuing the $15 target based upon Lancourt, Switzerland, and Dresden, Germany. Now a whole new catalyst comes in, a whole new factor. So, as I said, I could have sold it at 15 and doubled our money, and everything's hunky-dory, but something new came in, and we went back to the drawing board and said, no, let's hang in. And we did, because it zipped right through 15. Opportunistic, paying attention, putting your butt on the line, belling up to the bar, walking the talk. That's what you got to do. And you're questioned. I'm questioned all day long by clients. Let me get the last thing out. And then, how do they make overall portfolio decisions to determine asset allocation? Carefully. And you can't reduce all the risks. We're stock pickers. So there are times when you may think we're absolutely nuts, but we're picking stocks because they're too cheap.
Okay, last question. Running out of time, so you have the question.
One with thank you.
Okay, Bruce?
I was just going to the quarterly newsletter, and I realized that you're holding Western, actually.
Which?
Western.
Western.
Yeah, and I mean, usually, like, in this pool of these, we've been taught that, airlines are a really risky business, particularly profit, especially
Yeah.
the purpose, also change the core strategy. How does that, I mean, actually, what I care about, what you're going to tell me about this?
I just went through the same period, same question on Friday on television, so go into BNN. But we looked at WestJet for the following reasons. One, it's the lowest cost carrier in North America, probably one of the lowest, along with Southeast Airlines. Stock has done nothing for 5 years. It's back to where it was 5 years ago. Good management. Greg Soretsky now runs it. He just became president after 25 years in the business. He worked with Alaska Air and Canadian Airlines International. Company has a terrific balance sheet, $1.1 billion in cash and cash equivalents. Couple of catalyst areas. They opened up a credit card with a Royal Bank, a Visa. That'll bring them business. They've just changed over their reservation system to the Sabre, which will probably enable them to do various agreements with, well, they tried with Southeast Air, but they'll be with other airlines. They also have one set of aircraft. They have 91 planes. They're all 737s. Air Canada has about 10, 11, 12. So you just need one set of mechanics on this. Very efficient. Have you ever flown WestJet? Good airlines. If you can stand the bad jokes, it's good. We go to Florida a lot. We used to use Transat, but my wife doesn't like to leave 5 in the morning. This airline is good. They quite often they're on time or before time. More importantly, the rhetorical question I responded on television, if this company, because their earnings just came out, if they can make money now in the worst of times, what's going to happen when the economy turns? Now, Buffett would never look at a WestJet. It's too small. I mean, he could buy out the whole company like in one day. You tuck it in. Fact is, not too small for me. In fact, I wasn't able to buy it. I was able to buy it subsequent. They raised money at $11.20. I bought some stock, bought it all the way down to 10 3/4. Has been higher, but it, I think closed on Friday, I think at 12 and change. Like it. Excellent business model. Great management. And I think it's going to be there. And we expect to make money on this.
So last question, I guess, what is the biggest lesson you learned in your 30 years of money management experience?
There are a lot of lessons I learned. But one, aside from, whatever I've told you, I think the most important thing is humility. There's nothing like being long stock in a bad market, and there's nothing like being short when we don't short. Imagine being short and the market's going through the roof. I think you have to be probing. You have to have that touch of humility. Don't believe just because you had a string of wins that the next one's going to be the same. You can make money on 10 stocks. And you see, people tend to, they make money in stock, they increase their ante. They go bigger and bigger, and then they completely believe their own BS. And they go ahead and they put the big one in and they lose. And quite often it wipes out not only that trade, but all the other money they've made before. Humility. The market is very indiscriminate, doesn't care who you are. They talk of Mr. Market, they talk of looking at balance sheets, being a value investor. Believe in yourself, believe in your style, stick with it, but more importantly, keep that human touch, that humility. And I think that's important. Buffett does that. That's why he's so well loved. A lot of managers. There are other people who don't have that touch, and they're not as thought of as well.